Hi, I'm just back today to have a quick chat about what you need to do when you're setting up a new business. We're going to have a little talk about understanding the taxes you need to pay, keeping good records, and how you can reduce your tax bill. The first thing I'll say is you need to register for revenue as being self-employed. So you need to set up a revenue online service account, and you also need to register with the company's registrations office if you are trading under any name that is not your own name. So we'll first look at understanding what taxes you need to pay. So as a sole trader or as a partnership, you have to pay income tax, PRSI and universal social charge on the total profits of your business. If you have a limited company, then the company pays corporation tax at 12.5% on the profits. The directors then have to pay income tax, PRSI and USC on any money they take out of the business. The next thing you need to consider is whether you need to register for VAT or not. There are certain thresholds that if you think you're going to reach the thresholds in 12 months, you have to register for VAT. If you're selling goods, the threshold for registration is 75,000, and if you are selling a service, then the threshold is 37,500. So anything above those thresholds, you're obligated to register for VAT. And the last thing to note is if you have employees, you are responsible for deducting their income tax, PRSI and USC and paying that across to revenue. So the next thing I'm going to discuss is the importance of keeping good records. So it's really important from the very start to keep good records and get into good habits. So I would recommend that everybody does their own bookkeeping on a monthly basis. So that's not a complicated process. You can keep it nice and simple. Set up an Excel spreadsheet and once a month sit down with all your receipts and just input them into the spreadsheet, nice and simple. Keep all your receipts in a folder so you have them together so you can look back to them for your accountant at year end if you need to. And also keep a list of all your sales so you have your income. I would also say as well to set up a separate business bank account so all your income and expenses are going out of the one bank account, and it's much simpler than mixing it with your own personal expenses. As most of you would know, not all expenses are deductible for tax purposes, but I'm actually going to cover that in a separate video. So keep your bank statements, keep your receipts, keep a list of your sales, and if you do this on a monthly basis, it's going to be just so much simpler than waiting until the end of the year to do it just for your tax return. Also, it helps you keep track of how much money you're spending, what you're spending money on, whether you're making money or not. It's all really important to know your financials from the beginning. And I would also say at this point that there is no need to leave your tax return until the deadline, until November to do. There's nothing stopping you from submitting your tax return earlier in the year, but you still don't have to pay your tax liability until the deadline. So you could submit your tax return now in June, and you would know then if you have €1,000 to pay, you can budget for that €1,000 between now and November. So it really makes sense to get your tax return done early, and it also means that you're not looking for an accountant at the busiest time of the year and probably paying a premium for that service. And the big question that everybody asks is, how can I reduce my tax bill? So the first thing is everybody gets tax credits, and how much tax credits you get depend on your individual circumstances. So that really is a discussion between you and your accountant. You can also reduce your tax bill by deducting allowable expenses. So Revenue have guidelines out there for what expenses are allowable for tax purposes, and I'm actually going to cover them in a separate video because it might be just too much information for this one. You also can use capital allowances as a way of reducing your tax bill. So capital allowances are when you're given a deduction for buying an asset. So you can reduce your costs by a certain amount each year based on how much money you spent on the asset. And the other thing is then utilizing previous losses. So if it's your first year of business, you're not going to have previous losses, but if you make a loss in your first year, you can offset that against income from future years. So that is really all I wanted to cover today. It's at quite a high level, and I will do the allowable expenses video soon. And if you have any questions, just pop me a mail. Thanks.